start with the first two, which are the most important ones. The Securities Act of 1933 has to do with new issuances of security, especially focusing on disclosures, providing all the information that an investor would need to make an informed decision. For this reason, it's called a full disclosure law. Some of the rules include requiring a registration statement, providing audited financials, and a delineation of the business risks, as well as requiring that the information actually be true, so prohibiting fraud and misrepresentation. We have an acronym for this, RAD, which stands for Registration Statement, Audited, and Delineation of Business Risks. The next act is the Securities Exchange Act of 1934. This has to do with secondary sales, all the trading that happens after the initial issuance of the security. This act created the SEC, provides for oversight of the SROs, gave the Federal Reserve banks oversight of credit when buying securities, so anything having to do with margins is under the Federal Reserve Bank, and prohibited insider trading. For this reason, we have an acronym SOFI, which stands for SEC, Oversight, FRB, and Insider Trading Prohibition. The Maloney Act of 1938 set up non-exchange SROs, which are as opposed to exchange SROs like the NYSE. This act set up the NASD as an SRO for the OTC market. An SRO, by the way, is a self-regulatory organization. Any group that polices itself is essentially an SRO. So we can think of the Maloney Act as having to do with SROs. The Trust Indenture Act of 1939 has to do with disclosures around bond issuances. Because of this focus on disclosures, I like to think of it as similar to the 1933 Act, and this one focusing purely on debt issuances of greater than $10 million. The next law is the Investment Company Act of 1940. This has to do with disclosures and registration for investment pools of various investors putting their money together and putting it into an investment vehicle. For practical purposes, that's mostly mutual funds, but there are two other investment vehicles mentioned in the Act which are not very common, but we should cover: the face amount certificates, which act like discounted bonds, and a unit investment trust, which is a pooled investment which is completely unmanaged. It buys its securities and then essentially just lets it ride. So we can think of this, though, as being mostly about mutual funds. The Investment Advisors Act of 1940 focuses mainly on defining who an investment advisor is. Essentially, those people who make their living from providing investment advice for a fee and who have to register with the SEC and act in the client's best interest. There are other people who offer advice, such as lawyers and accountants, who are specifically excluded from being defined as investment advisors. And that's the main focus of this law. The next act is the SIPA Act of 1970. This provides for insurance for investors that have funds at broker-dealers, similar to the FDIC insurance for deposit holders in a bank. In this case, the coverage is up to $500,000 total, of which $250,000 maximum can be in cash. The rest is in various types of securities that the customer might hold. It also provides for the dissolution of an insolvent broker-dealer and sets up an organization called SIPC, the Securities Investor Protection Corporation, which runs the insurance program. So we can think of the three main points as being 500, 250, and SIPC. The next law is the Securities Acts Amendment of 1975. This set up an SRO focused purely on municipal securities, and that's what MSRB stands for, the Municipal Securities Rulemaking Board, which is exactly that. It just creates the rules, it doesn't enforce them. So we can think of the Securities Act of 1975 as being mostly MSRB. Insider trading becomes more expensive after the Insider Trading Act of 1984. It provides for penalties which are 3 times the profit that's made because of the insider trading. Up to this point, there were certain fines that that were imposed for insider trading, but the fines could be much less than the actual profit you could make from insider trading. So people could actually choose to pay the fine in exchange for making much, much more money by using inside information. It also makes liable the person providing the information as well as the person that trades on the insider information. So this is all civil penalties. By the time of the Insider Trading Act of 1988, we get to criminal penalties for insider trading. This results in fines of up to $5 million or $25 million for entities and imprisonment for up to 20 years. It also sets up rules that broker-dealers should enforce to prevent or discourage insider trading, such as creating restricted lists of securities, monitoring employee trades, and training employees as to what policies and procedures they should be following. So these are all specific penalties for the first time defined for insider trading. The Federal Telephone Consumer Act of 1991 provides protections for consumers against solicitation for securities, such as setting up a do not call list, setting up certain times in which the solicitations can be made, information that the caller has to provide, maybe not so relevant now, but prohibiting unsolicited faxes, and rules around auto dialers. And our acronym for this is DCCCUA, which kind of looks like Dracula to me, but hopefully that'll help you remember this. The last law that we have here is the penny stock rule of 1991. This has to do with small cap securities, which are more subject to abuse by broker-dealers and large fees which might not be fair to the clients. So this law provides for more disclosure around those penny stocks or small cap securities, establishing the suitability of those investments for the client, as well as disclosure of fees and commissions that the broker-dealer can make. So we can focus on this as being the small cap rules that we're protecting against. There's one other group of rules that we should focus on, and those are ones set up by FINRA, which is very influential among all the trading in the US. FINRA was set up by the combination of the NASD and NYSE in 2007. Its members are all the brokers and dealers who have set up certain standardized rules to facilitate trading. A group of these are the FINRA OTC rules, which standardize round lots of 100, how endorsements and assignments should be handled, delivery dates, these type of things which facilitate trading. There's also 3 groups of regulations for the OTC rules. The first having to do with the conduct rules, which are the operational day-to-day handling of securities. Then there's the code of procedure, which are the initial complaints and how violations should be handled. And then finally the code of arbitration, which handles the procedures for how disputes should be resolved. The other rule is the FINRA 5% rule. This is a standard rule of thumb for how pricing on commissions for very standard plain vanilla trades should be priced. These are trades which don't involve a lot of risk, high liquidity, and are very standard type of trades. There is a provision for charging more than 5% if the security requires more handling, such as with an exempt security, which requires more paperwork for private type of holdings, low liquidity or difficult to find securities for the broker-dealer, so that they can be compensated for those more difficult trades as well. Well, those are the main rules under the Major Securities Law section of the Series 7. If you have any questions or comments, please feel free to email me at john@passingscorefinance.com, and good luck on your exam.